Hey guys, so today we're going to talk about risk management. And the presentation is called Risk Management, the Holy Grail, because everyone's looking for the Holy Grail of trading, investing, that type of thing, and there is none except for maybe risk management. So, very, very important topic. So let's go through it here. Here's just a small definition of risk management, the forecast and evaluation of financial risk together with identification procedures to avoid and minimize their impact. Essentially, risk management is just seeing what could go wrong and trying to figure out how to make it not go that wrong. Pretty straightforward. So here's a couple different types of risk management. We're going to focus on the easier types because this is mainly for retail investors and traders, and they're not going to do things like value at risk calculations and Monte Carlo simulations and that type of things, but let's just go through the different ones. So one is just a basic stop loss. That's a good way to evaluate risk. If I want to get in at a dollar and my stop loss is at 50 cents, so I'm risking about 50 cents. It's the simplest way to look at what you're risking. Great in the futures market. It's a little bit more complicated in stocks and options because, as I'm sure you know, stop losses do not work in the overnight session. So even though you are estimating that as being your risk, you might be a little bit off. It might not actually be your risk. Value at risk, or VAR, statistical technique used to measure and quantify the level of financial risk within a firm or investment portfolio over a specific time. So essentially, value at risk, what they'll do is they'll look at statistical analysis and say, okay, within a 95% confidence interval, we think that the most that we could lose in a day is X percentage, and that's done with a variety of, again, deep calculations we really won't get into here. But if there's interest, comment below, and I can get into that later. So another kind is situational modeling. So basically, you'll look at the world and you'll say, okay, here's different ways that this could play out based off different situations, and this is what I estimate the risk in each of those situations are. The benefit of it is usually if you give a detailed description of what could happen, you have easy to follow risk parameters. The problem is that there's no way to account for every possible situation. Another way for risk management is just total risk. So if you're investing $1,000, you look at that as your total risk. The issue with that being that you're not going to have a full understanding of your risk in most circumstances because the odds of whatever instrument you have going to zero, obviously depending on the instrument, is going to be more unlikely. So why is risk management the grail? And this is the most important thing. This is why if you're not focused on risk management, you're investing and you're trading and you're even in your business, there's an issue here. So win rate flux, and that's essentially saying that although everybody would like to believe that they're going to be correct all the time, we know that that's not at all the case. So sometimes you're going to be correct, you're going to be correct 70%, sometimes you're going to be correct 30%. On average, you would like to be correct a little more often than you're wrong, but we know that even anything probabilistic in nature is going to have some sort of fluctuation in the win rate. So that's very important to note that that's just something that's going to occur. Is every now and then you're going to have some type of win rate fluctuation. So risk management will help prevent drawdowns during that win rate fluctuation. And then we're going to talk about that in terms of the coin flip game, which we will discuss shortly. That's an interesting way to look at investing and trading, is the way I personally look at it. So it's something to quickly look at and try to change your guys' mindset on trying to be right and focused on more of the risk management game. And then the third is it's very important for black swan events. There was when I worked with hedge fund admin, I went and I talked to a trader once who worked for a hedge fund, and his entire job was to man what they called the big red button, which was he was to sit there and watch and wait for any sort of black swan event, a flash crash, a terrorist attack, anything like this, and hit the big red button before anyone else could. So if you don't have risk management in place, any sort of risk management tool in place, and you're not thinking about that, you can get very caught in the deer in the headlights look in some sort of a black swan event. So it's very important to think about that beforehand. So we're going to talk about trading and investing as a coin flip. And this is how I always look at it, and I recommend you at least consider this as well, right? So we're going to run the rules of the game. So we're going to assume the odds are 50-50, and that's the best odds that you can get. A profitable flip, I pay you $5. A negative flip, you pay me $2.50. That's a great game for me. Even at a 50-50 win rate, that's an excellent game. Over the long run, netting commissions and slippage, all these type of things. The net is $2.50 a share. So a couple things to note here. That's how it actually works, right? We're trying to, with statistical analysis, with fundamental analysis, with technical analysis, we're trying to skew that 50-50 into maybe 70-30 or 60-40. But even with 50-50, as long as we are managing our risk properly, we will still be profitable at a 50-50. So we're talking to that's the benefit of it. And then the other thing that we really have to note is we have the ability to withstand drawdowns. We need to understand that using this type of model of looking at investing and looking at trading and focusing very hard on risk management is that we are going to have runs in either direction. We're going to have runs of profitable situations and runs of negative situations. So in theory, with a 50-50 coin flip, it is possible for it to land as a negative flip 10 times in a row. So the other thing to note when you're developing some sort of risk management procedure is that you are able to, regardless of how you calculated it with value at risk or a stop loss or any of these different ways, is that you build in an ability to withstand a streak against you, right? You have the ability that if 10 coins flip up tails, you're not done. You haven't blown up, right? So, think about this and think about trading in this way, and I think it will really help you. Trading, investing, we're just playing the numbers, right? Regardless of how you come up with the numbers, we're just playing the numbers. So in conclusion, good risk management can be a difference between profit and loss. I know many traders, many investors who say they're right 60-70% of the time, but they still lose money and they want to know why. It's because they don't have a good risk management plan. So it can definitely skew things greatly in your favor, and it can definitely skew things the other way if you're not careful. Always live to fight another day, and that has to go back with the ability to deal with drawdowns. If you develop a risk management with a stop loss, and you're right that 50% of the time, if you haven't built in the ability to survive those 10 negative coin flips, then you're not going to be there for the probabilistic nature of sometime in the future getting 10 positive coin flips, for example. And always have your risk management plan down before entry. If you look at a stock, if you look at a commodity or whatever it is you're planning on investing in, before you enter the position, you should have the plan written down. Whether I'm writing an algorithm, whether I'm looking at a long-term position, I know 100% where I'm going to get out before the entry occurs. And then just a nice little cliche there, right? A fail to plan is a plan to fail. So, I just something to mull over, something to think about. Maybe stop thinking about each individual position. Sometimes we can't see the forest for the trees because we're worried about the next position. But if we detach ourselves and we think of the game as a coin flip and we just worry about trying to weight that coin in our direction while keeping our risk management very rigid, sometimes it will give us better results in the long run. So until I see you guys next time, Trade safe.